Thanks for joining another Treece Talk. And it's interesting. Sometimes we think there's not that much happening or it's more of the same. Of course, Friday was kind of wild in the market. So today we're going to give an update on the stock market, the economy, interest rates, inflation, and what's happening this week, and our general take on where we see things going. So just to recap, the stock market had a bit of a correction is too strong. Correction we refer to like a 10% drop, but we had one of the largest drops in probably a year on the NASDAQ. But overall, the Dow is up year to date 5.66%. For all of this volatility, this up and down, these numbers are not huge. The S&P is up 8.18%, and the NASDAQ composite's up about 11.5%. But there have been a lot of big swings there, including on Friday. So I'm going to talk about that and why that happened, and what we see going forward. So the Nasdaq plummeted 1,121 points on Friday, a 4.2% decline, and its biggest one-day point drop on record. The S&P was down 2.6%. When they give these statistics, like the biggest point drop on record, of course, the indexes are getting larger numbers. So when you look at the points, you're going to see these kinds of drops. But as a percent, this is what really matters. And this is like the biggest percent drop just since last year. So this is not something historic by any means. Why did this happen? And the reason is we had very good May jobs data. And so this has fueled investor concerns that the Fed is going to be less likely to keep interest rates on hold. On hold, referring to not only would there not be as much of a likelihood of cutting, but there may be interest rate increases. So going from on hold to increasing rates is the concern. And so that's because the Fed has a dual mandate of controlling inflation and also maintaining employment stability. So if the job market is relatively strong and the inflation is sticky, they can focus more on inflation, and that's where you would increase interest rates to try to slow things down and control inflation. So just to give some more feedback on this, this is from Market Watch. Investors are worried that labor market on the mend would make it more difficult for the Federal Reserve to justify leaving interest rates on hold. Expectations for more rate cuts this year evaporated months ago. And I've been saying that with this inflation, especially with energy prices, the war in the Middle East, none of this is favorable to doing rate cuts. And in fact, we are seeing on some of the insurance rates being offered, the rates have gone up. In fact, we sent out an email that we're seeing significant rate increases being offered to savers. So these interest rate increases are very good for savers. They're not good for borrowers. So expectations for more rate cuts, I said, evaporated a while ago since the start of the Iran conflict. Markets have been steadily pricing in a higher likelihood of rate hikes in 2026, coming on the heels of a handful of promising economic reports, including the May jobs data, that we can see that the labor market has been picking up. And so it's funny, often it seems like good news in other ways is bad news. And that's just the nature of how the market has like a push and a pull. So, but what we're looking at now this week are the inflation numbers. So tomorrow we have the CPI, the Consumer Price Index coming out. And on Thursday, we have the Producer Price Index coming out. It is expected that these numbers will continue to go up. So for the Consumer Price Index, it is expected to reach 4.2%, which is really getting higher based on current forecasts. That's up from 3.8% yearly rate a month ago. And of course, this is well above the Fed's 2% target inflation. So here, is inflation a question? Asked Robert Tripp, chief investment strategist at PGIM on Monday. It's more of an accepted problem at this point. Fed officials were hoping inflation would be transitory over the past few years, and that hasn't worked out. Of course, this was the famous criticism previously, Jay Powell, under Biden, with all of the spending that, oh, this is transitory, this will go through the economy. And of course, it did come down significantly, but it lasted quite a while, and it still has not come down to near where the Fed's target has been. Tip said it now looks as though the economy could have supported a higher Fed funds rate some time ago. This is another criticism, that the Fed lags behind in these decisions. I'm not sure I share that. There just needs to be more evidence, I think, and typically they will move slowly not to make a big mistake. That might not mean that Warsh, we have a new incoming chair of the Fed, and the meeting is next week. We're not expecting any interest rate changes for the meeting next week. We're also in a silent period, so there will be no Fed speak, Fed announcements during this week. It's like a blackout period. So we don't expect Warsh will increase rates next week at his first policy meeting as head of the central bank, but he may need to start talking about it when you get inflation over 4%. This is from Cetera. Cetera Investments puts out some really good information. They have something called the Fedometer. That's like the Fed meter. And they're right in the middle between what is the chance of rate cuts or rate increases. And I think the market is timing in a higher probability of a rate hike towards the end of the year, and maybe even one towards the beginning of next year. So it's a quick summary. Since the Fed's dual mandate is to keep prices stable and maximize employment, we'll focus on the labor and inflation metrics here in their study, keeping in mind the broader economic impact as well. So we have a new chapter starting with Kevin Warsh replacing Jerome Powell as chair of the Fed. Despite the change in leadership, we do not expect an immediate shift in rate policy. Warsh will oversee the same group of voting members, including Jay Powell, who will remain on the board of governors. As a result, the Fed is likely to remain on hold for the foreseeable future. That said, the Fed's rate cutting bias may shift towards a more neutral stance as the Fed pivots from labor market concerns toward renewed inflation concerns. That's fairly predictable given these numbers that are coming out. And of course, we'll know more tomorrow and Wednesday with the inflation numbers. This is a key point. Future markets are now pricing in higher odds of a rate hike before the year is over, higher odds of a hike than a cut. So it's still kind of neutral. So we're expecting an extended pause with no changes in the rates, but rate hikes are now back on the table. So that's something, again, that we're going to pay a lot of attention to. So we've got these two reports coming out on inflation on tomorrow, Wednesday, and then on Thursday. Also on Friday is the Index of Consumer Sentiment from the University of Michigan. That hit the lowest reading ever. And now we're expecting some rebound. The Cetera is predicting that the Index of Consumer Sentiment will not be as negative. And part of it has to do with easing of some of the oil prices. One of the ironic things as I read the reports is time after time after time, it's like, oh, we're expecting the war to end. We're expecting this to wind down. We're expecting a peace agreement. And it's like, oh, every 2 or 3 days, there's an announcement of some potential breakthrough. And none of it is real. And my impression is very negative, that there's absolutely nothing happening right now that indicates a resolution to this anytime soon. So that's my personal take on it. So this will continue to be an issue, and it will affect parts of the economy, particularly sectors that rely on energy, like the airlines. They're expecting basically to have huge impacts on their profitability. So that's something we're looking at. The other thing I want to mention, and also we can, any questions or comments, feel free to put into the chat feature. People are asking about these initial public offerings, IPOs, and it's always been a strange situation. It seems to me that we don't participate in these, and there are reasons for that I'm going to talk about. Of course, we're looking at OpenAI filing for an IPO, but on Friday is this SpaceX IPO, and the valuations are expected to be through the roof. to say that this is again from MarketWatch. Elon Musk needs the cultish support. This is the headline: cultish support of everyday investors to pull off the massive SpaceX IPO. So this is a business publication, MarketWatch. This is not anything political, but when you look at the numbers, this is where I want people to have some analysis. And also this will tell you a little bit why we are somewhat limited with IPOs. The influence of SpaceX CEO Elon Musk is a major reason the company is likely to break records with its upcoming IPO, initial public offering. Here is a key point. SpaceX's IPO uniquely targets retail investors, reserving up to 30% of shares for them, far exceeding the typical 5% allocation. So this is something that's being marketed to the average retail investor. And the more that you get people buying into, I mean, we've seen waves of things, whether it's cannabis, cryptocurrency. Some of these, we used to call them Reg D, that is investments for sophisticated investors who had a high net worth. And the idea was that they would be in a position to sustain losses if things don't go well. A lot of these things have just been opening up to the public more and more. So this is another kind of unique situation. And it's just something to keep in mind. That fear of missing out is very real. People want to get in, and then they say, well, if this doesn't work out, I'm going to hold it. And that's often the case. When people come to us with some of the stocks that they bought on their own, or they will ask about some of these, often it's way beyond what we would consider their normal risk tolerance, but there's clearly a fear of missing out. One thing I want to share, this was just historical data about Facebook, or now Meta. This is posted as a reminder as IPO activity heats up. Even the most successful companies often have painful starts. And I'm going to get into this, why we are regulated in the way we are. After its May 2012 IPO, Facebook fell 54%, peak to trough, and finished its first year down 31%. The broad stock market was up 31% over the same period. Ouch. So that's where these valuations are hard to know. A number is placed there. Is it realistic? Is it undervalued? Is it going to soar once it becomes publicly traded, or will it go the opposite? People tend to expect when an IPO comes out that it's just people are going to buy, and it's going to go up, up, up. And that is just not the case. Not always the case by any means. So in terms of what we do regarding IPOs, we are so regulated in so many different ways. And typically, we are not participating in any IPOs. And the reason has to do with, again, all the regulations, FINRA, the Financial Industry Regulatory Authority, and SEC, suitability obligations. So in short, here are some points to take into account on IPOs and why we are regulated the way we are. When an IPO is first offered, there's often very little public information and no trading history. If the stock performs poorly after the offering, regulators may scrutinize whether the recommendation was suitable. That is, if we are reaching out, encouraging somebody to buy a brand new stock with no trading history. And so the broker dealers are concerned about that, the suitability requirements under the rules, any problems, complaints. So a lot of firms conclude it's not worth the risk. Often, this is another issue, there's a very limited supply of shares. So many of these IPOs are oversubscribed. So this creates an allocation problem. So the investment banks underwriting the deal typically allocate shares to institutional investors, mutual funds, pension funds, hedge funds, and large private wealth clients. So people feel like they're being left out, and there's some truth to that. But so by the time allocations reach the retail channel, there may be very few shares available. So there are also concerns then on favoritism, like who gets access to these. Another concern on an IPO is just the reputational risk. If an IPO rises 50%, clients who did not get in, couldn't buy, are upset. If it falls 50%, clients who did get shares are upset. So there's a strong possibility of being in a bad position. There's concerns about conflicts of interest. A broker dealer may have an investment banking relationship with the issuer, an underwriting role, or just a desire to maintain institutional relationships. This is a topic for a whole other Treece talk about conflicts of interest, what's going on in Washington, pardons of financial criminals, Ponzi schemers, you know, Sam, so Bankman Friedman, he's asking for a pardon, after causing billions of dollars in losses. And it's not unthinkable given who else has been pardoned, but this is the world we live in. Another thing is the allocations to retail investors, unlike what's been happening here with SpaceX, where it's like 30%, they're typically very small. And so this also creates a problem of how do you allocate that, that there may be more demand than can be met. And so it creates that allocation issue. So those are some of the reasons that it's generally off the table for us to try to get people in on some of these IPOs. Once it's traded, that's another issue. But as the actual initial public offering, we don't have an ability to be involved in that here, generally speaking, as retail investors. So I just wanted to comment on that. I think there's some education there in terms of how the markets work, how we are regulated, and also just in general, how IPOs work. Because I think there's this idea that people make a ton of money always right at the beginning, and it's not necessarily that way. So there's we've seen some things that were basically non-traded, like some REITs, real estate and investment trusts, that they've gone for a long time illiquid, and finally the owner, the issuer, says, well, we have to make this liquid. We're going to go publicly traded, and it opens at a loss, and sometimes a significant loss. But that's the only way to make it liquid. That's another issue. So just because something goes public doesn't mean the value is going to go up. So that's So those are my comments for this week. So it's an interesting week for news coming out on inflation, the IPO on Friday, the last Friday's little market tantrum, we'll say. And of course, there was a rebound on Monday, which is very typical that if the markets get quote unquote oversold in one day, there's a rebound. This is not necessarily, but that's what happened here the following Monday. And of course, some of this is news driven. So often those news driven events are very short lived in terms of their effect on the market. And the markets tend to look at earnings, interest rates, inflation, policies, those kinds of things, the GDP, economic numbers, unemployment. So that's it for me for this Treece talk. So just to recap, the markets overall have been growing. There is risk, there is volatility. We think that will continue. However, the managers that we are working with are still fully invested. We don't have managers sitting on the sidelines right now. Of course, we work with managers who will get out of the market. They will reduce risk. But right now, everybody is still invested, cautiously optimistic. We have positive forecasts for GDP growth and also positive stock market forecasts for the end of the year. But again, the risk out there is significant. So that's where we want people to be invested in accordance with their risk tolerance. And our approach is to make things more conservative for people who are afraid of losing money. So we get it set up that way from the beginning with managers who reduce risk. So, Robert.
David, hi. If you can hear me okay here.
Yes. Yep. Sure can.
Great. Well, this is our question and answer segment. So please put your question into the Q&A box at the bottom of the screen. David will answer your question live. Let's get started. David, you covered a lot of ground and there is a lot going on. At this point, we were able to tackle, as you mentioned, the recent market sell-off on Friday, rising prices having to do with inflation and what the Federal Reserve might do next. Even though the market had a big drop, it is still up overall this year. You also explained inflation is staying higher than expected, which could keep interest rates high. We're all excited about this IPO that's coming up, and we went through the particulars and what we can and cannot do, the risks, and also other popular IPOs that have been in the past. Today, please, and once again, we're going to look out for those questions as they come in. First question: which economic reports are investors watching most closely right now?
Since we had the positive jobs report, it's definitely the inflation reports coming out now. And since the expectations are for rising inflation, that's very significant because of the effect on interest rates. That's where the stock market, again, had this, for the NASDAQ, over 4% drop on Friday. If we continue to get high inflation numbers, then we're much more likely to get rising interest rates. I do want to say that a lot of this is negative. If you're a saver and you can get 5% at the bank, where there's a time we had higher rates, people may pull money out of the stock market and say, well, why should I take this risk if I can, still get a decent rate? So we've seen that in the past. So these rates can be very bad news, certainly for the stock market and also for the people who are using debt when the rates go higher, that for mortgage loans, car loans. One of my concerns is if you have inflation that's sticky, partly energy prices that are, again, driven by the situation of the Strait of Hormuz, and you end up creating other problems that slow down the economy. When this is getting back to the K-shaped economy concern that I've had, that at some point, if things get tougher and tougher and tougher for people because of inflation, energy prices, rising interest rates for car loans, mortgages, that's where you start to see an economic slowdown. Nobody is predicting a recession right now, but this is the kind of thing that you look at to see how it starts. And of course, the idea is if the rates go up, you're trying to quash the inflation, and that, of course, is very positive in the long run. But this is something that affects people terribly in the United States. The rising cost of living, affordability, and it seems like it's just getting worse and worse for a lot of people. So if we have rising inflation, those are to answer the question, those are the two reports that we're going to look at. And again, next week, there may be some comments from the Fed about this, depending on what the numbers are. And I'm going to be interested on the index of consumer sentiment on Friday, because despite the fact that it was so low and there's this expectation of it being a rebound, I'm not so sure about that. If people are still feeling very negative because of the Middle East situation, energy prices, inflation, that may still be reflected in the index of consumer sentiment. And that is considered a leading economic indicator, meaning forward-looking. If people are concerned that the inflation is going to be higher, the economy is going to be worse, then they stop spending. And again, that's also been reflected in some of the corporate earnings, particularly on consumer durables, more expensive products like appliances. Whirlpool has made announcements that they see a slowing down here of people buying those consumer durables. So there's all sorts of things that we look at. It's way too early, but you can see some trends. And that's where, again, we want people to be positioned if things start to go south. We have had 3 good years in a row in the stock market. And to get 4 good years in a row is asking a lot. Not every year is an up year. Right now, it's still been an up year, and the forecasts are still positive. But we see a lot of risk.
Together, these reports, they may influence expectations for future Federal Reserve policy. You also mentioned higher energy prices that can ripple throughout the economy. Airlines, you mentioned, as far as other industries where higher energy costs remain, that affect, as you said, with the K-shaped economy. There is this big question. Has the change in Federal Reserve leadership altered the outlook moving forward?
It's a great question because it's so funny where Trump appointed Jay Powell and then just criticized him and trashed him, and then even seemed to forget that he's the one who appointed him. So often people are appointed in positions expecting to do something, and then they end up doing something else. And of course, he is, even though he's the chair and a spokesperson, he's one vote, and so we don't necessarily expect wildness where somebody's going to be trying to buck the economic numbers and do something that is, counterintuitive to, or even destructive. The issue on the Fed and interest rates is often timing. Are we going to cut rates? If so, when? Are we going to raise rates? If so, when? And by how much? So looking back, that's where you'll get criticisms where, well, they should have started raising rates a long time ago, or vice versa, cutting rates because they should have seen a slowdown coming. So my expectation is that Kevin Warsh is not going to be radical or doing something unexpected or that goes against the economic expectations. So there's a lot of politics involved clearly here, more than ever, I would say, because of all the political pressure, even a legal case that was put against Jay Powell. And now that there seems to be some backing off on that and saying, let them do what they need to do. But of course, it's always true that the powers that be, whoever is in charge, whatever political party or president, they want, when election time comes, they want a strong economy, and often that means we want rates to be cut to stimulate things. And here we are in a position where that's just not likely. We're going to, if anything, it seems the market is pricing in a greater chance for a rate hike towards the end of the year rather than a rate cut. So that's an issue.
Thank you. Without the IPO of SpaceX being available to everybody as an IPO, you mentioned before about a secondary market. Could you explain the difference between an initial public offering, an IPO, and what is the biggest difference between the secondary market?
The secondary market is where it's available to the public, and you can see the valuation on an index. And there right before this, this is investment banking, and it's trying to raise money for these companies and to sell these shares. And there's all sorts of evaluation as to what the price is, the value of the company is worth. It's the market that tells you to some extent what the value is. So you're trying to predict how the market responds. And that one article, it had a lot to do with the personality of Elon Musk and then you look at some of the underlying fundamentals, such as the price to earnings ratio, things like that. So to take a company public, there are several ways to do it. We used to have this, we still do this SPAC model, special purpose acquisition company. But this is all on the investment banking side, and it's generally not for retail investors. Once it gets on the secondary market, then it's open to retail investors. And there's this perception, and there's some truth to it, that you see this with university endowments, the hedge funds, that they have access to some of these investments that the retail investor doesn't have. And that, they can outperform sometimes because of it, but of course they're taking risk as well. So that's in some ways, I think it's a great system to be able to create a company and take it public. And that's a sign of, I think, a capitalist economy, so to speak, that people can create a company and invest in it and raise money, take it public. But of course, there's enormous amounts of regulation involved. And we have companies where we see, of course, they trade for pennies. And anything under $5 a share, we consider what's called a penny stock. And these can be super volatile. There can be manipulation. So I mean, it's an interesting thing. Of course, our concern is for the retail investor, our clients, that they don't have surprises. And that's where we work in the secondary market, where it's open to the public, and we get a better feel for the value of something. Of course, we also have all sorts of services we subscribe to, Morningstar, Vector Vest. Um, there's just a lot of analysis out there. And of course, the money managers that we work with have their own analysis. And so we can combine all of this to get a feel. I mentioned to one of our newer clients that people will come to us with a request about a company, about buying a stock. And we look at this and there's like no earnings. It is absolutely something that we would not recommend, particularly often these are more conservative investors. And it's just something that they heard about us. It could be word of mouth. It could be watching a business news program. And so we get into it and look at it and say, oh, it's $90 a share, and the analysts think it's worth $4 a share. And you do get those, not uncommon, those discrepancies. So and again, you have to take that with a grain of salt, because it could be that it's still too new to fairly evaluate, and that there's a lot of growth potential still.
You pointed out that a lot of investment opportunities, once limited to the high net worth or sophisticated investors, have become increasingly available to the general public. Whether discussing IPOs, alternative investments, cryptocurrencies, or other emerging opportunities, maintaining a disciplined investment approach remains far more important than chasing the latest headline opportunity. SPACs, that brings me back to when it became extremely popular in the COVID days, as initial public offerings had found different ways to get into the market. Well, that
You know,
wraps up our question and answering segment. We're going to leave it to David Trotman to take us home with some slides and some future announcements.
yes,
Thank
and I'll shut up.
Oh, no. David, no, I always learn so much every week, even though we work together. I still learn more from the Treece talk. And like our philosophy is we care about your wealth and your well-being. So you handle the wealth part, and I handle some of the well-being. So I just wanted to share a bit of other things we have coming up to take care of the other aspects of not having a life lived well. So tomorrow we are hosting, through our Levita Pride initiative, the last of a series of queer end of life planning focused on the LGBTQ community and the unique aspects to that. We've had guest speakers, and we work with the Stonewall Village group out of New York City to have a panel on this. Tomorrow is the last session. Like I mentioned, it's about an hour and a half with a presentation and a discussion. And the last one's going to focus on intimacy and relationships at the end of life, how they change, how they can be made more meaningful, and how we can say what we need to do, say what we need to for our loved ones before we are gone. So I found this fascinating. So I hope people can join us for that. It's open to everyone, LGBTQ and allied communities, because we all experience end of life. So it's not focused on one sexual orientation or not or other. And the other one is our bi-monthly Aging in Pages book group. I see a couple people have signed up for this one. This just happens to be about loss and grieving and healing too. Moving on doesn't mean letting go is our next book for that. So on June 24th at 2 p.m. online, you go to our website for either of these, you could sign up, and hopefully you can join us. With that being said, hope everyone has a great week of wealth and well-being, and we'll see you in July for our next Treece talk. David?